If you bought the house after January this year, then it qualifies for bonus depreciation. And so we do a cost segregation study where you take all the things in the home that might qualify as equipment. So anything that's 15, 7, or 5 year life, we can use bonus depreciation to get an upfront deduction. It usually comes out to about 20 or 30% of the home cost. So people get, 200, $300,000 deductions up front, and that goes against your income. So if you make $300,000, you're going to owe zero tax that year that you do a cost segregation study.
For that particular person, that story you shared with us, do you remember how much money you saved for him or got him back?
Yeah, I can't remember off the top of my head. It's hard because we saved him almost 70,000 in prior years just by changing the depreciation method for prior years and also doing a late S election. I think we saved him like $70,000.
70,000 is quite a lot. Some people earn that much during the year, right?
Yeah.
On the flip side, can you share an example of a misdeduction that cost someone big time? When someone came to you and they really missed a lot.
Uh, yeah, some people don't uh, track their business miles for their car. That's a big one. People just assume, oh, my car is not a business vehicle, but if you're not, taking it as a business vehicle, you can still get a certain percentage on the miles that you drive. And so if you use an app, there's like Mile IQ is a good one where you can track your miles, and um, that's a great deduction that you wouldn't have been taking before. And doing an accountable plan, a lot of people don't think you can write off, your personal expenses for your home, which you usually can't. But if you have a home office, you can write off whatever the home office is entitled to. So, say you have 4 rooms in your home, and one of them is a home office. 25% of your mortgage interest and utilities and HOA fees, lawn and landscaping, and cleaner, and uh, even home office depreciation, uh, you can take as a deduction in the business using an accountable plan. And a lot of people don't know that, but it's a real legit strategy, and it's a great one to get tax-free money by getting a large deduction.
What is one tax strategy every real estate investor should at least consider?
Real estate investor can probably do an accountable and Augusta plan, and they should be paying estimated quarterly taxes 4 times throughout the year, uh, and probably being an S corp as well. Being an S corp, doing an Augusta and accountable plan are kind of our bread and butter. That's what most real estate investors qualify for all three of those. And it's a really easy way to save tax. When you become an S corp, you don't have to pay self-employment tax. And when the S corp is a separate entity from yourself, you do an Augusta plan where you rent out your home for 14 days or less during the year. That's a non-taxable event. And your business rents your house for 14 days. And we document that. You do a fair market value rental rate. And so you pay yourself tax-free rent. And the accountable plan, where you reimburse yourself for the business use of your home. So all your expenses, your mortgage interest, your utilities are all deductible, certain percentages. Um, and that's also a um, tax-free payment from the business to you. And all real estate investors should be doing that.